Imagine two Australians. Both earn exactly $200,000 a year. Both own the same investments. Both made the same amount of money. But one of them pays thousands less in tax. Not because they're smarter, not because they're working harder, but because of a legal structure most Australians barely understand. It's called a discretionary trust, and according to the Treasury, families using these trusts pay about 4 percentage points less tax than families earning the same income without one. Now the government wants to change that. They're introducing a new 30% minimum tax on discretionary trusts. And while politicians say it's aimed at wealthy Australians exploiting loopholes, tax experts are warning it could hit family businesses, farmers, tradespeople, and ordinary investors as well. So what exactly is a trust? Why does Australia have more of them than almost every other developed country? And could this tax change create problems nobody is talking about? Let's break it down. To understand why this matters, you first need to understand how most Australians earn money. If you work a job, you get paid. The government takes tax. End of story. Simple. But wealthy people often don't own assets directly. They own them through structures, companies, partnerships, and trusts. Think of a trust like a treasure chest. Inside the chest might be rental properties, shares, businesses, farms, investment portfolios. The trust owns the treasure, not the people. Now here's where it gets interesting. Every year, the trust makes money, and decision needs to be made on who receives it. That role is called the trustee. And in a discretionary trust, the trustee gets to choose. That's the key word, choose. They can decide who receives the income every single year. And that's where the tax advantages begin, all perfectly legal within the system. Let's keep things simple. Imagine Australia taxes people using buckets. Small buckets get taxed a little. Big buckets get taxed a lot. If you pour all the water into one bucket, it overflows, more tax. But if you spread the water across multiple buckets, each bucket stays smaller, less tax. That's basically how income splitting works. Imagine a trust earns $120,000. Without a trust, one person receives all $120,000. They pay tax according to their marginal tax rate. But with a trust, the trustee might distribute $30,000 to mum, $30,000 to dad, $30,000 to adult child number 1, $30,000 to adult child number 2. Suddenly, 4 people are utilizing 4 tax thresholds. The family's total tax bill drops dramatically, legally. And that's why trusts exploded in popularity. Today, Australia has more than 840,000 discretionary trusts. That's an extraordinary number. In fact, Australia has far more trusts per person than countries like the UK and United States. Why? Because Australian trust laws are unusually flexible. Most countries don't allow this level of discretion. Australia basically created one of the most powerful wealth planning tools in the developed world, and wealthy families noticed.